the spotlight on Tata Consumer Products. Sunil D'Souza, the Managing Director and CEO, in conversation with Nikunj, talking a little bit about the earnings fine print.
Well, when you have Sunil D'Souza on the show, you have lots of things to talk about. Quarterly numbers, big acquisition, what is happening in rural India, and which is the new innovative product line Tata Consumer is coming with. So, Mr. D'Souza, good morning. Thank you for joining us. What should we start with? There are lots of things this time.
I would say the thing to start with is the quarterly results. I think we delivered a decent set of results. 9% top line, 26% EBITDA growth, and 31% if I take off the one-off, which is charge relating to some 20-25 years back. 31% growth on EBITDA, on group net profit. Volume growth across the businesses. Tea, foods was strong. International has come back to the party, 11% top line growth. Our growth businesses keep on firing, overall a 42% growth, and all the businesses are plus 40 now. EBITDA margins are now north of 15. Working capital down 7 days. We actually generated 40% more cash in Q3 this year versus Q3 last year. Close to 3,000 crores of cash was sitting on our balance sheet, and I say was because we're going to use it now for the acquisitions. The other thing, Nikunj, I'll take it up front, your favorite topic of ROCE, 260 bips up year on year. So that is something which we keep on watching. Market shares overall, while if you take the MAT numbers slightly softer, we hit record salt shares in December, all-time highs, close to 39 plus now in value terms. Quarter on quarter, beverage shares are up. In fact, we've gained close to 30 bips on volume. Our closest competitor has lost 30. Distribution on track, 4 million outlets now, numeric reach. Innovation, like you mentioned, is now 5.3% this quarter versus 3% last year. So all in all, business firing on all cylinders. And more importantly, we are adding new engines of growth with Capital Foods and Organic.
Okay, I'll come to specifics of the acquisition. But one concern which everyone, it's not a concern, but it's an observation, which is that you're losing market share in your tea business, and that decline has continued for the 5th quarter on the trot now. Is that a conscious move?
So Nikunj, actually speaking, we quote the moving annual total, right? So it's a sum total of the last 12 months. And that's why I said, if you look at the last 12 months, it is a negative 68 bips, 0.68%. But if you look at quarter on quarter, in value, we've gained 16 bips. But more importantly, volume, we've outgrown our competitor. We've grown by 30 bips versus competition, which has lost 30 bips. So not too worried out there. It's a basic question of execution. And our focus on growing the premium end of the teas is coming back. So the mix is very strong. The Indian beverage business is now, gross margins are up by 500 bips. So on a very strong wicket. I wouldn't be overtly worried. We've just got to get execution done behind our plans.
Okay. The acquisition, which in a sense has got everyone talking and thinking, for a company which in a sense was really growing organically, has taken a big leap forward. What was the thought behind it?
So Nikunj, we've always maintained that we want to be a premier FMCG company. And in the premium FMCG company, we said we will first focus on growing our food and beverage business before we venture into the broader FMCG. So these moves are part of our growth into the larger FMCG business, so to speak. 3 years back, or 4 years back, when we started our journey, we had mapped out the entire food and beverage universe. And you have to remember, we started life as a tea and salt company, effectively, which are basically commodities. So one of the big thrusts was to get into value-added foods and beverages. And when we looked at the landscape and what we could do organically, we had mapped that out, and that's why you see our innovation numbers very strong as we expand in the categories or the brands that we have and we play with. But then we also said we will grow both organically and inorganically. And when both these assets came into the market, when we evaluated them, we figured, given the fact that we have a strong S&D system, given the fact that we've built a strong R&D, digital infrastructure backbone at the back, and the fact that we have a global footprint, we calculated the value that we could generate. Capital Foods, hats off to Ajay Gupta and his entire team for having built a very, very strong brand with Ching's. Literally market leaders, number one, number two positions in all the categories that they operate. I think it gives us a platform to rapidly expand into the food, value-added food space, if I may. Organic India, very, very strong back end. One of the biggest things, we spent the maximum amount of time understanding the fact that it was really organic. Once we convinced ourselves of that, then we looked at the portfolio. Herbal supplements, a trend across the globe. Not only in India, but we've got opportunities to grow outside India. Organic foods per se is a trend which is catching on. These people have fantastic products. They were just limited by distribution, so to speak, 24,000 outlets. So we thought we could really multiply it. So we've got the base infrastructure on which we'll plug on these platforms. There is significant amount of cost that we can take out in the middle of the P&L, apart from the fact that we'll grow top line at significantly higher levels than where they are today. So all in all, fulfills a very small portion of our ambitions, so to speak, towards becoming a large premier FMCG company.
This acquisition would be funded via internal cash, which is there on your balance sheet, and also right issues. So I'm assuming in this case, the promoter, which is Tata Sons, they would be participating and their holding post the right issue could go higher?
Right now, Nikunj, we've said we're going to utilize the significant amount of cash lying on our balance sheet, and we've announced a rights issue of 3,500 crores. Yeah, the promoter does back up saying that they will subscribe to any unsubscribed portion of the rights issue per se. So one step at a time. Right now, that is what we've announced.
And when you see the right issue will be announced?
Yeah. So we've already got approval from the board. We've already started working towards the rights issue. I think overall within, I would say about 4 months or so, we should be coming out in the market.
3 years out, Mr. D'Souza, once the acquisition integration would be on, I mean about 18 months to 24 months is the minimum time you would require to look at integration, supply chain, distribution. What will happen post that to my favorite number, which I always ask you, return ratios? I'm phrasing it differently this time, so that you cannot preempt it.
No, so Nikunj, let me say, actually Capital Foods, we had the final closing board meeting on the 1st, and we started invoicing on the first evening. We've already finished a substantial part of the front-end integration. By February 15th, we should be done and dusted. In the next, I would say probably 70, 80 days or so, we will finish the organization integration as well as the back end. So within 100 days, we should be done. Organic India, we expect to close sometime in March, I would say. And again, the target would be to finish integration within 100 days. The reason why, A, is we quickly remove any uncertainties that are lingering around in both sides, our organization, their organization, number one. The go forward is clear and we get to executing plans. So we do aim to start creating value very quickly, number one. Number two, return ratios absolutely focused on. As I said, we are 260 bips up in this quarter versus same quarter last year. So that keeps on inching up. So the base business, we would continue to increase ROC. But of course, as we grow, as it requires capital, we are building a platform for the future. But from wherever we are, there will be a target of significant increasing of ROC numbers.
No, but because you've acquired what is a premium food business, and the Organic India business also is a very high margin business. It's a very niche business, but high margin business. On a blended basis, if this acquisition, what would be your return ratios? And 2 scenarios here, sir. Imagine a scenario where these acquisitions would have not happened. Then what would have been the linear growth for return ratios? And post this acquisition, what will change in terms of return ratios?
So Nikunj, first I'll talk about the return ratios without those businesses per se, and that's why I alluded to our EBITDA now being north of 15%. Remember when we started off 4 years back, we were in the 11, 12 sort of number. We've come to a 15% plus while growing top line, I would say almost best in class in the FMCG space currently. And we are in touching distance of some of our close competitors who are considered good operators in the Indian FMCG business on EBITDA percentage numbers. So that's where we brought the base business per se. very, very conscious that as we bolt on acquisitions, we need to make sure that the overall return ratios need to continue to grow. We do think we can create substantial value. And while we do that, we calculate IRRs for all the acquisitions, and they pass all muster with our board in terms of the targets they have set, which again, the board is very, very conscious of ROCE. So I would say incremental top line, but more importantly, significantly incremental bottom line, precisely because of what you said, high, very, very high gross margin products.
You know, when I asked you last time that are you on course to beat Morgan Stanley estimates, and I referred to that number publicly. Now that question was asked before the acquisition. So what do you have to say to latest take from Morgan Stanley?
So all I would say is, Nikunj, we remain focused on driving execution, making sure we provide best returns to our shareholders. My team continues to focus on top line, making sure bottom line grows faster than that, so that on the given capital invested base, we continue to improve.
For your existing portfolio, can I say inflation plus 2% or 3% is the kind of growth which is now the base number? That's the bare minimum at which your existing portfolio will grow?
Nikunj, all I would say, if I grow at that rate, then we've not done justice to the faith reposed in us by the board and the shareholders. So I'll split it into two different pieces. One is our tea and salt business, and one is the growth businesses. The tea and salt businesses, you're absolutely right. We've always guided for volume growth in the mid-single digits and a couple of basis points on top of that to take us to high single digits on overall revenue growth. But the big part of our business is the growth businesses, which this quarter again have grown 40%. These businesses now contribute to roughly 17-18% of the India business per se. And I would dare say we would exit the year close to a 19-20 contribution. That is growing at 40%. On top of that, we're bolting on our capital foods and organic, so as part of the growth engine. So I would say high single digits, low double digits would be the bare minimum for us.
Okay, so I'll ask a couple of questions, just maybe last but one question. I'll be specific here. When do you think you would be able to go to 20% operating profit margins for your new acquisitions, which is Capital Foods and Organic India?
If I take it off separately, Nikunj, and if I, by operating margins, I would take EBITDA percentages as the norm. I would say Capital Foods will get there very, very quickly. Organic India, I would say 3, 6, maximum 9 months, 20% plus EBITDA, not a difficult piece. And the reason I say this is because, as I said, in the synergies that we've calculated, there is substantial amount of cost takeout that we can do given the scale that we operate in. So not a very difficult proposition. That I would say is par for the course. The game is how much more can I add on top of that?
Okay. So in terms of growth business, I'm assuming that this is the growth business category which you've always categorized for us, which would also include, let's say, the entire portfolio of, Nourishco, the protein portfolio. How much total contribution will come from growth businesses for Tata Consumer in FY25 and beyond?
So Nikunj, we've said, we've always guided saying we will grow our current growth businesses at a 30%. I think when we put out our acquisition numbers, we said we aim to take the contribution of growth businesses from 20% today, which is growing at 30%, to 30% very quickly, continuing to grow at 30%.
Okay. Mr. D'Souza, Street is really divided. Some are confused, and there are conflicting data points on rural economy. Now, HUL is saying that volume growth is not there. Motorcycle companies are saying that, look, we have a problem in terms of what is happening to two-wheeler sales. But if I look at data points, which is, let's say, coming from an Tata Consumer, or which is coming from an Marico, or which is coming from your V-Mart, the data is very different. What is the right way of looking at rural consumption demand?
So Nikunj, I would say I would not compare myself with the other companies for the simple reason that my distribution opportunity and share opportunity that lies in rural, which is, I would go one step further and say semi-urban and rural, which is where my weak numbers are. that is where I have to gain. So my growths are coming from these geographies, but just with the rider saying that we were weaker and therefore we are gaining in those geographies. Overall, from what I hear, what I see on the ground in my market visits, my salespeople telling me, etc., rural demand seems to have stabilized and seems to be coming back, albeit it is not at the levels where it was pre-COVID. But I do remain hopeful given the fact that we had a fairly decent monsoon. We've got an election season, and therefore I would expect a little bit of more spending in the economies going forward. And from all forecasts that we see right now, it's going to be a normal monsoon. So I remain hopeful that we'll see rural demand coming back strongly.
Mr. D'Souza, 15 minutes into today's conversation, we've not spoken about inflation concerns. Now, if inflation is speaking out, that technically will have an impact on volume growth per se, because the price hike FMCG companies are taking. Now, if inflation is stable, what happens to the price hike and the volume growth, which is also a function of how price hikes are taken?
So Nikunj, broadly in our portfolio, whether it is the base commodities that we use or the input items that we use, we see broadly benign inflation. Whether it is tea, whether it is salt, almost stable pricing in India. Coffee is a bit of a volatile commodity right now, both in India and international. That is something we got to tackle. A slightly smaller part of my portfolio. Oil is benign, so therefore the downstream inflation we don't expect to be too much. Broadly benign costs. Now, if costs are benign, we've taken all the, I would say, price increases to put margins in the right place. And I do think overall, whether it is India tea, India salt, or my international businesses, gross margins are broadly where we want them to be. Now the game would be volume growth, and we are seeing volume growth. For example, even in salt, where now we've roughly for a significant amount of time we've not taken any price increases, we've seen volume growth of 5%. That is where we want it to be, so it's broadly come back to normal. In tea, we have seen 4 successive quarters of volume growth. So broadly, the game will now be focused on volume, given that costs are benign.
So final question, Mr. D'Souza, if I put the numbers, acquisition strategy, contribution coming from growth business, market share gain, volume growth, will I be conservative if I say that in every 2 to 2.5 years, Tata Consumer has potential and aspirational to double its turnover?
I wouldn't exactly comment on that particular thing. Nikunj, all I'd say is double-digit growth, continuing gain on market share, and delivering bottom line, which is faster than top line growth.
But as someone who's tracked Tata Consumer, if I'm putting my numbers together, am I thinking right? Just give me a hint.
We would be targeting very, very aggressive growth numbers. But again, I would say profitable growth. Margins have to continue to expand.
Which means profit has potential to double in 3 years.
We've not done the math exactly that way, Nikunj, but yeah, aggressive numbers.
All right, sir. Really appreciate your time. Thank you so very much.
Thank you, Nikunj. Thank you.